Imagine a marketplace where billions of dollars change hands every single day. A place where fortunes can be made and lost. Some people build life-changing wealth there over time. Others lose money because they never understood how it really works. But here's the question. What exactly is the stock exchange? Is it just a playground for billionaires and Wall Street professionals? Or can an ordinary person use it to build long-term wealth? And if companies are already making money, why would they sell pieces of their business to complete strangers? By the end of this video, you'll understand exactly how the stock exchange works, why it exists, why millions of people invest in it, and, most importantly, I'll show you how beginners can actually start using it. Trust me, the last section is where everything finally comes together, so don't skip ahead. Let's get started. Part 1. What is the stock exchange? Imagine you started a business. It grows faster than you ever expected. Customers love your product. Sales keep increasing. Now you want to open new locations, hire more employees, and expand your company. But there's one problem. You don't have enough money. You have two choices: borrow money from a bank, or sell a small ownership stake in your company to investors. That ownership is called a stock or a share. The place where those shares are bought and sold is called the stock exchange. But here's something many beginners don't realize. The stock exchange isn't just a physical building. It's a highly regulated marketplace where buyers and sellers trade company shares safely and transparently. Every trade follows strict rules. That's exactly why millions of investors around the world trust it. And here's something even more interesting. Not every company is allowed to list its shares on a stock exchange. Only companies that meet specific financial and legal requirements can do it. But why? We'll answer that in just a moment. Part 2. Why do companies use the stock exchange? As businesses grow, they need more money to build factories, open new offices, develop new products, hire talented employees, expand into new countries. All of that requires capital. Instead of taking on massive debt, many companies choose to raise money by selling a small percentage of ownership to the public. This process is called an initial public offering, or IPO. When investors buy those shares, the company receives fresh capital to grow, and investors become partial owners of that business. But here's where things get interesting. Once a company goes public, its share price starts changing every single trading day, sometimes every few seconds. But what causes those prices to rise or fall? That's one of the biggest mysteries for new investors, and we're about to break it down. If you're finding this video valuable so far, make sure to hit the like button. It really helps the channel. And if you're new to investing, don't miss my video called Investing in ETFs Explained. In that video, I explain why ETFs are one of the most popular investment choices for beginners and how they can help reduce risk through diversification. I've linked it in the description below. And stay with me, because later in this video, I'll show you how beginners actually access the stock exchange and place their very first investment. Part 3. Why do stock prices go up and down? Every second, buyers and sellers are competing in the market. When more people want to buy a stock than sell it, demand increases, and the price usually rises. When more people want to sell than buy, supply increases, and the price usually falls. Simple enough. But what actually changes demand? Company earnings, breaking news, interest rates, the economy, new technology, global events, and perhaps the biggest factor of all, investor confidence. That's why the market can soar one day and drop sharply the next. But here's something experienced investors understand. A falling market isn't always bad news. In fact, many investors see market downturns as opportunities. How? We'll get to that shortly. Part 4. Why do people invest in the stock exchange? Most people don't invest just to trade every day. Many invest for the long term. Some want passive income through dividends. Others are saving for retirement. Some invest to stay ahead of inflation. And many simply want their money to grow over time instead of sitting in a bank account. But here's the truth. Not everyone succeeds. Many beginners jump into the market without understanding what they're buying. They let fear control them when prices fall, and greed control them when prices rise. That's why successful investing isn't about luck. It's about knowledge, discipline, and patience. Remember this: your greatest investment will always be your financial education. Part 5. How do you actually use the stock exchange? Now it's time for the part I promised at the beginning. You don't buy stocks directly from the stock exchange. Instead, you open an account with a licensed brokerage. From there, you research companies, choose the investments you believe in, place your order, and once it's executed, you officially become a shareholder. But buying stocks is only the first step. Successful investors focus on 3 things: risk management, diversification, and patience. That's why experienced investors rarely put all of their money into just one company. They build diversified portfolios designed to perform over the long term. Final thoughts. The stock exchange isn't a secret club for the wealthy. It's a financial system that helps businesses grow while giving everyday people the opportunity to become part owners of those businesses. But remember, the stock exchange isn't a machine that prints money. It's a system that rewards patience, discipline, and informed decisions. The more you learn, the better your financial future can become. And if you'd like me to show you exactly how to buy your first stock step by step, make sure to subscribe and turn on notifications. Because that's exactly what we'll cover in the next video.